Lecture 5. Liabilities. The main objective of this lecture is to interpret the conceptual basis for the liabilities component of the balance sheet. A liability is defined as a company's legal financial debts, or obligations that arise during the course of business operations. A liability is typically an amount owed by a company to a supplier, bank, lender, or other provider of goods, services, or loans. Liabilities can be listed under accounts payable, and are credited in the double-entry bookkeeping method of managing accounts. Liabilities are characterized by the following. They are present duty or obligation, that entails the probable future transfer or use of assets. They are related to a particular entity, which is the business that has the duty or obligation. And the transaction or event giving rise to the obligation has already occurred. Liabilities may be classified into current and non-current. The distinction is made on the basis of time period, within which the liability is expected to be settled by the entity. Current liability is one which the entity expects to pay off within 1 year from the reporting date. Non-current liability is one which the entity expects to settle after 1 year from the reporting date. Current liabilities are obligations expected to be eliminated through the use of existing current assets, or by the creation of other current liabilities. Typically, those due within 1 year. Examples of current liabilities include accounts payable, sales taxes payable, income taxes payable, accrued expenses, customer deposits. Accounts payables are the trade payables due to suppliers. Company purchase merchandise, goods, and services from suppliers. These purchases are usually evidenced by supplier invoices, and typically reported at invoice amount. An accrued expense is an accounting expense, recognized in the books before it is paid for. It is a liability, and is usually current. These expenses are typically periodic, and documented on a company's balance sheet, due to the high probability that they will be collected. They are typically not discounted. Examples: salaries payable, interest payable, taxes payable. Long-term liabilities or non-current liabilities are financial obligations of a company that become due more than 1 year. Reported at present value of future cash payments. In accounting, they form a section of the balance sheet that lists liabilities not due within the next 12 months, including debentures, loans, deferred tax liabilities and pension obligations. Examples: note payable, types of borrowings evidenced by formal written documents. Bonds payable, a common type of note payable, that usually includes a more formal borrowing agreement. Deferred income taxes, possible obligation for the future payment of income taxes, that have been postponed due to accounting methods. End of Lecture 5. Thank you.